Some investors believe that BP, the upstream oil and gas driller, might be too cheap to ignore, and that's what I want to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back and welcome to the new studio. Now, here's an interesting article that I saw on Barron's. They actually said that BP has been ignored for a long time and it's very cheap relative to its peers and very cheap just relative to the growth profile that it is expected to have. And so this is what I'm talking about. So this was the Barron's article that came out on January 21st of this year. And essentially what it's saying is that the company is pivoting back to what it does best, which is exploring for oil and gas. And what do they mean by that comment? Well, they meant that the former British Petroleum didn't make their investors happy after it said in 2020 that it would seek to cut its hydrocarbon production by up to 40% by 2030. So here you have a upstream oil and gas developer or driller who's no longer doing what they're meant to do, and instead they're trying to diversify into less carbon intensive industries. And they intended to do that by directing an increasing share of their spending to clean energy investments, including energy vehicle charging stations, biofuels, hydrogen, and renewable power. And so it looks like they've actually had a change of heart. The company has refocused on its oil and gas business, particularly its US oriented operations. And by 2030, the company aims to boost its American oil and gas production by more than 50% and get half of its projected output of 2 million barrels per day from the US. So BP is effectively turning into a half American driller. Now, right now, they're trading at 7 times projected 2024 earnings. And that really seems cheap even for European energy companies. And this is what I mean. This is BP stacked up against their peers. You can see at the current share price, the dividend yield is the highest, of course, at 5.1%. But notice that the PE, the forward 2024 forward PE, is around 7 times earnings, whereas the closest competitors, Shell, obviously Exxon and Chevron, are much higher. Now, the company plans to spend around $16 billion a year through 2030 on capex. Of around $7 billion of that is going to be spent on transition growth engine. So what does this mean is that the old BP is not really going away. They're still trying to transition to sort of like green energy projects and areas, and that's where I think the company could run into potential problems. And that's why I think investors are discounting their earnings capabilities, because there's still somewhat of a headwind there. Investors aren't happy with BP's wind business, where they took a $540 million charge last year for a financially unviable offshore project in New York State in partnership with an oil company. And so, investors are really saying that the company needs to deliver in upstream, which is what they're supposed to be delivering on, and focus on the higher returns of the low carbon value chain. So this piqued my interest. I wanted to know exactly what their valuation would look like if I just made like a rudimentary valuation. And that's what I'll share with you. I actually made 2 scenarios for them. In the first scenario, you can see that I am reducing revenues in 2023 because they're expected to come down, and then a little bit more of a reduction in 2024 and in 2025 and in 2026. And then, of course, I just sort of flatline revenues going out. So this is what I would consider sort of like a worst case scenario or a bear case scenario type of valuation. And one important item to consider in all of these is that profitability was at a high watermark in 2022, with 12% of free cash flow materializing from revenue. But that has come down to 8% in 2023. At least that's where 2023 looks like it's going to end. And it could decline further beyond that in 2024. So you can see that I've taken that down to 6% going forward. So effectively, under all scenarios, I'm going to be forecasting a less profitable company. And so what does the bear case scenario valuation look like? Well, just using a terminal multiple of 10 times earnings, which is the same multiple as its higher valued peers, which I don't know if it'll even capture that. So this might not be as bear of a scenario as you would originally think. Reducing their excess cash, which is debt in this case, so they have a negative excess cash, you're looking at a valuation of around $38 per share. The current share price is $34 per share, so you're looking at approximately a fair valuation of approximately 90% of what I think its bear case scenario intrinsic value is. So that's actually not a bad place to start. And I would probably consider this more of a pessimistic scenario as well, because I never generally build models on a real bull case. But here, you still expect 2023 to go down by 10%. I think that's where they land. 2024 comes down a little bit, and then you have a little bit of growth. Recall, guys, that they did say that they're expecting to significantly ramp up production in North America. And so even at 5% revenue growth year over year, that may not be sufficient to address the amount of growth that they expect. But what does the valuation say, at least even at just this level? Well, you can see that the valuation is $51 per share, which is approximately 70% of its intrinsic value using this scenario. But the other thing that I want to remind you guys of this scenario is that this scenario takes into account the fact that I've significantly reduced the profitability of the company. If they're pumping more and prices remain stable, they could maintain profitability of 8% free cash flow materializing from revenue, not 6%. So there could be substantial upside from this. The other upside to this scenario, of course, is that revenues are growing at a faster rate than what I'm forecasting. But I would say that the upstream oil and gas space is a tough space to forecast. You really got to understand the projects and the companies. This is more just high level. The guys who are actually following BP in this particular space are going to have much granular models. As time goes on, I will build more granular models for upstream oil and gas names as well as midstream names. But there are a ton of models that are available for you right now at that lower tier of the pay chart, and this is what I'm talking about. So you can see there's BP on the tracker. There's their intrinsic value relative to the current share price, trading at around 90%. And then you move up, there's Foot Locker. There was a time where Foot Locker was really cheap. It was one of the largest names in my portfolio. Now, since it's run up, it's sort of come off the portfolio. Alibaba seems to be one of the cheaper opportunities. Alibaba and these Chinese names have remained cheap for a long time. And there's some doubts if these names will rebound or not. But there's a whole slew of other names that are hidden under this gray shading, which also provides some interesting opportunities. And you can click into how I build out the valuations just by clicking into right here, as similar to what you saw with BP as I showed it. But you can click into each one of these and it takes you to a full model of the particular company in question. Now, speaking of the next question that you may have, how do you get access to that tracker? Well, if you join us on our Patreon, which the link is down below in the description and in the comments, you can get access to the tracker and all of my research at $5 a month tier. And if you want to join us for even more content, we actually have live monthly calls, special live courses, and a comp schedule which compares the regional banking industry against itself. And that's over at the $15 a month tier. And there will be a subsequent third tier coming on where I'm going to be teaching you guys monthly how to model particular types of companies. And we'll go through all sorts of questions that you may have. And that's limited to just 25 people. And so all this is coming. And of course, as usual, thank you guys very much for tuning in. And I'll see you later.